Hello everybody, welcome to the Cyclical Investors Club YouTube channel. We are going to kick off a new series of videos that I plan to put out where I use a, really just earnings and earnings trends in order to predict stock prices or estimate stock prices 4 years from now. So this combines and simplifies in many ways a lot of what I do in my more complicated analyses. And so this will be the first article where I kind of run through it, but it's not just going to be a series about individual articles. We're also going to track the results over time to see what we can learn about this valuation method. And I'll not only be looking at what the returns could probably be as an estimate, but also comparing those to what I think the returns of the S&P 500 or a cash equivalent might be, and then deciding between those three options, the stock, cash, or an index, S&P 500 index, what would be the better option over the medium term of about 4 years. So I picked some kind of precise dates, but really in real life, all these are estimates. So that's important to keep in mind. It's not saying this is exactly where it's going to be. It's if you analyze enough stocks and you get a range of kind of where they're going to be, then the idea is you can pick the very best ones, or the ones that have the best odds. And if you buy enough of those and your system is pretty good, then you'll generally do pretty well. Usually I expect about 80% of my predictions to be pretty close, especially on the relative basis, which is what we're going to also look at here. So that's kind of my baseline goal / expectations. I mean, if I was way below, if I end up being way below that, then I would think about making, and there's not like an obvious explanation for it, then I would think about definitely making some adjustments to my approach. Okay, so this is the first time I'm working through this in video form, so I'm just gonna do it on the fly here. I did write an article for the Cyclical Investors Club. There was kind of a test run and a beta for this style of article that I'll hopefully be publishing a lot of in the next year, and then also making a lot of videos about. So it's not maybe perfectly dialed in yet, but we're gonna give it a go. The first thing I would start out by saying is that I always check earnings cyclicality first, okay? So I have a fast graph pulled up here of Consolidated Edison. I picked a pretty boring and easy stock to analyze from an earnings perspective for this first one, precisely so it's pretty predictable, generally speaking, and you could pick other utilities that they're earning like low single digit earnings growth, okay? Not huge declines. Even during recessions, you just have like an 8% earnings decline. So these are every other year right here until you shorten the graph. So the first thing I like to check actually is to see just how cyclical earnings are. Earnings are represented by this green shaded area here. And if you go down here, it'll tell you what the percentage change is. I'm going to shorten this graph a little bit so it shows each individual year in these early years. Okay, so we have a couple recessions here. It looks like here maybe close to a 20% decline total if you take all these. And then an 8% earnings growth decline, but still positive. They just earned less money than the year before. So what I'm checking here is if this comes in and it's like more than 50% in a year, then those earnings are going to be too cyclical for this style of analysis. And I have a separate style of analysis that I use for cyclical stocks. But rather than look at the industry, rather than look at what traditionally might be considered cyclical or not cyclical, I ignore all that usually, and I go and look at what the earnings actually did and use my own standard, because that's what matters. So there's a couple different ways that can go. If it's a newer business, they might not have enough data really for this style of analysis. I really require that there be a real recession. I mean, we technically had a recession in 2020, but it wasn't like a normal recession. So for this style of analysis, the first thing we need is data that goes back to about 2006 or 7 at a minimum. All right. So if it's less than that, then there's just not enough data, and you can't, it gets trickier to use this kind of analysis. I usually avoid it unless there's like a really good peer company. But you never really, the companies will always tell you they're not cyclical. Nobody ever comes out with a new company or doing a new thing and says, "Oh yeah, we're just as cyclical as we." No, they always say they're not. So don't believe any of it. Don't believe any analysts. Don't believe any of that. Go look at the actual recession and see what their earnings actually did during the recession. So that's the first kind of thing. There needs to be the data, all right? And then the second thing is you need to see how cyclical earnings are. And the third thing is you want to see how predictable earnings are. So sometimes you'll have these, with some companies, they'll just be like a dive in the middle of like a random year or whatever. You can go investigate and try to see what the cause of that was. If it's just if it really is like a one-time thing, you can kind of ignore it maybe. If it's, a big write-off or a scandal or something, I mean, that might be a red flag. But those type of declines aren't really like cyclical declines. Those are more volatile declines. And then, because certain businesses also, like an insurance business, they'll have a year where there's a bunch of claims, and that will be a big down earnings year maybe, right? So it's just random. It doesn't have anything to do with the economy. You want to kind of look at them, judge them. If they're super deep, then maybe they're just taking on too much risk. That's not an insurance company I would buy. I don't usually use this on too many insurance companies to begin with, but every now and then, if it's a well-known, big, well-established, well-diversified kind of insurance deal, I'll value it based on historical earnings and just take into account the down years as long as they're not too big, right? So you just want to judge each individual company on its own. Now, this is a pretty easy one. There aren't any like giant earnings declines. We have the data and all that. So this is kind of perfect for an earnings-based analysis, which is what this is. So once we kind of establish that, the next thing we need to do is, because this is such a long time frame, I could actually do it with this business because it hasn't changed very much, but a lot of businesses have changed since 2006, like more than 15 years ago. So usually I'll check this longer trend. I'll kind of note what sort of earnings decline they might have during a recession. Sometimes you'll see years that are kind of similar, like here and in 2020. So that's pretty representative of kind of what happened back here. So in this case, usually kind of 2015 is where I start with my time frames here. And then I just use my judgment after that. Okay. So I'm going to take a time frame that goes from 2015 to either 2022 or 2023. So when we do earnings, we'll look forward to 2023. But when I'm calculating the earnings growth rates, I will take into account this decline here. I will take into account this decline here. Now that's a little bit different than the way that Fast Graphs does it. They measure from this point to probably 2022, and then they just assume it's kind of a straight line in between them, and that gives you a 3.06% earnings growth rate. Now there's basically going to be two metrics that we need to do the basic analysis here: the earnings growth rate and the current PE ratio, or earnings yield. So the earnings yield is just the inverse of PE, so E over P. I think Fast Graphs might put it on here now. Let's see. Yeah, so according to them, my numbers are going to be a little different than theirs, but they at least show it. So they have a blended PE of 20.49, and then the earnings yield is 4.88. I think mine came out to 5.09% when I wrote this article, which is a few days ago. So definitely in the same ballpark, but slightly different. So the two metrics that you need to figure out are the earnings yield, which I calculate all these myself because I have my own way of doing it about what I think is important and care about. If you're doing a shorthand, you can just look on a fast graph and take this and then take the earnings growth rate. I would say my estimates are almost always more conservative than what are on here because I take into account two things. I take into account buybacks, which, let me go to my article here. So this was the point I was talking about earlier. You look at the earnings cyclicality. And then the second thing you want to look at are the shares outstanding and what they've done over that same time period. Because now with Consolidated Edison, they've issued a bunch of shares, so this is reflected in the earnings per share already. But businesses that are buying back shares, that will actually inflate the EPS growth rate. So I control for that. So if this had bought back 20% of the company instead of issuing more shares, then I would adjust for that. And that makes my earnings growth rates more conservative, usually, always, basically, than like fast graphs or almost any other way. But it didn't matter for this particular one. So generally speaking, the only difference between what I'm doing and what fast graphs is calculating when it comes to this earnings growth rate is I'm looking forward a full year, or now, yeah, it's almost a full year now, and to here, and I'm going to count this estimate, and then I'm going to deduct a little bit for these slow earnings years, okay? So when I calculate this all out, what I end up with for my earnings growth rate is 2.23% compared to 3.06% for fast graphs. So they're still in the same ballpark. You know, you're kind of doing the same thing basically in a slightly more conservative way. But we can see that really these guys are just, we'll call that growing at the rate of inflation, even though we've had more inflation in the past couple years. We didn't have hardly any during here. So basically, on an earnings basis, they're like, on a real earnings, they're flat. They're going to go up with inflation, basically, but no extra growth. And then the earnings yield, which I use this number for, and that's 5.09%. Again, so I'm a little more generous here because I'm looking forward a year and pulling it in. So we have, those are our two metrics that we need along with our time frame, which is 10 years, okay? So I cut everything off at 10 years. And basically what we're going to do is we're going to figure out if you kept all the earnings, if you started with this, which the way I like to think about this is if you bought this whole business for $100, you would earn $5.09 your first year, and that would be growing at 2.23% per year for 10 years. I want to know how much money would I collect if I owned this business, right? So I have a little table here where I break all that down so you can see how much this grew each year and then the cumulative effect. And you have your initial $100. So you have $100. It grows into $157.58 after 10 years of earning if you just collected all the earnings. And if you put that into a compound annual growth rate calculator, it gives you a 4.65% CAGR for 10 years. So for me, that's how I value pretty much all businesses that have stable and predictable enough earnings trends. So that basically tells you what the business is worth per year over 10 years. And then if your investment just kind of ended and you got back your original money. So now the tricky part is, okay, that's what your 10-year annual return would be. What we want to know is, okay, well, given where everything stands now, where would we expect the stock to be in 4 years, okay? And so that is where this kind of comes in handy. So I'm going to compare this one to just itself, okay? And then I'm going to compare it to the S&P 500's expected 4-year returns, and then TFLO, which is basically a cash equivalent expected returns over 4 years. And I created a calculator and a spreadsheet to do that. And so in the Cyclical Investors Club, you can use this. You can type in the PE, which this is the Ed's PE right now, and then the earnings growth rate, and then it will tell you, it will spit out, it's based on the 10-year earnings CAGR, but it's over 4 years, and this is what you would expect, like a 21.54% return. The S&P 500, this is if sentiment just for the stock stayed the same as it is right now. So people just treated everything the same except for the earnings went up, and then the price would go accordingly. And these are what the returns you could expect. And I did the same thing for the S&P 500, and then the same for cash. So we would expect like a 21% return, about the same for the S&P 500. So they're pretty similarly valued if sentiment stays just how it is now. Cash is pretty close to that. And so you have a little bit better return, very slightly better return, considering this is over 4 years. You're talking like single digits. And so, but the question then becomes, okay, what happens if investors change their sentiment and they value, because right now utilities are really expensive. If you just look at this, I mean, and you do any valuation, you have a 20 PE with 2% growth, right? Or let's call it 3%. We'll call it a PEG ratio of like 6. I mean, that's just crazy expensive. There's no reason, I think anybody would like look at that and think that it would produce a good return. But if we base it on historical averages, so long-term historically, the market tends to value businesses at about a 7% 10-year CAGR. That's been my observation, and it's kind of what I use as my midpoint for fair value for any stock that I'm using earnings to judge it on. So what I did was I said, okay, well, what happens if what happens if the market demands that instead of a 4.65% 10-year CAGR, it gets a 7% 10-year CAGR? Well, in order for that to happen, the price has to fall, okay? And the price goes down, your expected returns go up. So the next one here is, if we just assume that it reverts to that 7% valuation, 10-year CAGR valuation, then over 4 years, the total return would be about negative 18%. So that's the real danger with this stock. And then you say, well, what about the S&P 500? Is it overvalued too? And the answer is yes, it is overvalued too, relative to the same metric. The S&P 500 will probably lose about 11% over that time frame. So it's losing a little bit less than what we would expect Ed to lose. I think where the real issue comes is that cash would earn 17% over that time period if it earns 4% per year, which is about what it's doing now. And that would actually outperform by about 3,500 basis points. So the question isn't really, okay, should I own a utility or should I own the S&P 500? It's probably, should I own a utility that's only growing at 2%, or should I just own cash and then I don't have to worry about that downside risk if the market changes its mind and decides it doesn't want to pay that much money for a utility anymore. So I think that's the real risk that comes out here. Now, if this is more than 25%, then I would consider that stock a sell. Okay? So, because what I would say is cash will probably outperform Consolidated Edison stock at some point over the next like 4 years. And it will probably do it by a margin of at least 2,500 basis points or 25%. So that would be my prediction, and then I go through kind of my ratings here. So I would say this stock is a sell, and if you move money into TFLO instead or some other similar cash equivalent that pays like 4% or more on a risk basis over the next 4 years, that's probably going to do better. Now, at some point, as the Consolidated Edison stock price comes down, that risk will be diminished, and there'll be some point at which, if a person really liked whatever the stock is, in this case it's Ed, then they can move that cash back in there when that risk is better, basically when the price comes down. So what I'm predicting is that a 2,500 basis point spread will open up between TFLO and Ed here at some point over the next 4 years. Is very likely, I think. So that's it. Now, it takes a little while, I think, to kind of totally understand what's going on here if you're not used to it. But after you work with it and think about it a little bit, it's really just about what sort of earnings is a business making, how much of that could I collect as an owner, and then the next step is, how does the market usually value that over the long term? And you can do it without the market, expectation in there. I think the more accurate way is to probably assume some mean reversion and then have a relative basis compared to something like cash or the index, like I did here. Now, let's see if I share the prices here. So I didn't talk about what level I would buy Consolidated Edison stock, but I think at about $45 per share, it probably would outperform the S&P 500. I like to have a margin of safety and a certain threshold of return on top of that. So like $40 per share is what I would personally aim at. Now, these are below what would be like fair value. These are for if you want to get better than market returns, which for me is, if you're buying individual stocks, then your goal should be to do better than average. Otherwise, you just buy the index at any given time. Those are pretty low compared to where the price is now, which is 90, so like half. It would probably have to lose half its value to be attractive to me. Some people will be willing to pay more. A lot of people will be willing to pay more because they just think it's safe because it's utility. So they think there's less risk. I don't necessarily. I mean, it depends on what you're comparing it to. I care about the risk return. So that's where we are. I would rate this one a sell. I will. I'm gonna track this and see if that 2,500 basis point spread opens up between this or cash or TFLO, and then we'll follow up on it on a regular basis with any of the other stocks that I decide to analyze this way. Okay, thanks for going through this. I'll probably get a little smoother in terms of the explanation as time goes on. Feel free to ask any questions in the comment section, and thanks for watching.